Welcome back to my channel. So I'm talking a lot about passive income. If you followed any of my articles on Medium, and if you haven't, you should. So there's a link down below. Go check them out. So today I figured we're gonna take a look into my dividend investment portfolio and how much I'm estimating that I'm gonna make this year on it and how I'm intending to grow it. So with that said, let's just jump straight into it. But before we get into all these numbers and stuff, there's one important thing you're gonna have to help me with. Do remember to like and subscribe this video, because it helps me out a lot with the algorithm, and it's also gonna help me build yet another income stream. So if you are in this together, please remember to like this video, subscribe to my channel, and let's start having a look at it. So just to make sure everybody's aware that this portfolio is quite new. If I'm gonna link some articles down in the description about they're gonna go some more into detail about my portfolio, because I write an update roughly every month, at least every quarter. So go check out those out if you want like my brand ideal of the market and all these kind of details, because today we're just gonna get like into the basics of it. We're gonna have a look at the numbers, the sectors, all this stuff that I'm working on, just to give you guys like a brief idea of what I'm thinking, what I'm working on, and how hopefully this is gonna turn out, unless I end up losing all of it and end up flat on my ass again. So the first chart on the screen you see somewhere, either here, maybe it's even down here somewhere. I don't know where we're gonna put it yet, but wherever you see it on your screen, there should be a chart, and it is basically my current portfolio holdings. There should be some known names there, like Altria Group. Brookfield is probably a company that a lot of people haven't heard about, but a lot of people have been in one of their buildings. They are a massive real estate investment trust, and they own pretty much all the big buildings everywhere. I'm not joking. Going further down the list, we have a couple speculative positions right now. There's some real estate investment trust based on hospitality that they have been crashing between 40 and 60%. And again, there's going to be more details in the article link down in the description, so go check that out if you want. But with the current discount that the market is representing on these kind of stocks, I figured out that as long as they're not going to be major positions, I could just as well take a risk and buy a couple of them. Because people are gonna start traveling again sometime, and they're gonna have to stay somewhere. So long term, I think there's a possibility for a pretty nice rebound in these kind of real estate investment trusts. So if you have some extra cash lying around, you could put them into these ones, because you're gonna get them at a great price right now. But as always, these are real estate investment trusts, and there is certain risks. But if you go into the details of their real estate portfolios, you're gonna see that most of it is very central, nice properties. That is not gonna change anytime soon. Host Hotels has properties on Times Square, Fifth Ave, all these kind of places in New York and other big cities. Park Hotels has the same, with different luxury hotels in different major US cities mostly, not so much in foreign countries. So they are pretty safe. Like, as long as they keep their debt burdens at a decent level, they should be safe, and their dividends will start hiking again at some point. So next out, we're gonna see that real estate is a large part of my portfolio, because real estate investment trust is where most of the dividends come from. At these kind of like volatile times, it's good to put them into real estate investment trust, because they keep paying out dividends either way. Unless they crash, but then we're all screwed either way, so then what's the point? If we're gonna consider all the companies to crash, you could just as well put them into your piggy bank and just leave them there. Inflation's gonna eat them up, but you're gonna be safe for crashes forever. So the next big group in my portfolio, as we can see if we go a little bit further down on the list, is energy sector. Energy sector has always been very popular for dividends, because they always have a very good stream of cash, incoming cash in their companies. And as long as they keep the cash coming in, they're always going to be able to pay cash out back to the investors. The only issue here is the current prices of oil. Oil prices has crashed massively. If you haven't noticed, this is a chart right here for oil prices, and it hasn't been pretty for the last year or so. So I would probably stay away from oil companies right now, and I'm just keeping Occidental Petroleum in my portfolio as a reminder of how much I messed up. I think my loss there is roughly 60% right now. Luckily for me, that's a very small position, so it won't matter much long term, but I'm just keeping it there as a little bit of a reminder because it had a very nice dividend yield. I think it paid out like 15% when I bought it. So I got greedy and I bought it. And served me right, it crashed right afterward and they slashed the dividend to 0.01 cents per share per quarter. So instead of giving me that very nice dividend, I'm getting roughly 4 cents per stock per year. So the yield is pretty much nothing. I haven't even dared to calculate it yet. I think I actually have some numbers down in the description somewhere. Maybe if I'm tough enough to actually face my losses and calculate it. Otherwise, you're very welcome to calculate them yourself or just stay away from it for now. So if you look at the chart, most of them lie around a steady 10%, like if you just look down on the charts, but some of them are a little bit higher, some of them are a little bit under, but most of these are steady stocks. Like, they're not gonna go anywhere. They have a long history, most of them, and they have been keeping their priorities straight with paying out the investors and keeping their balance sheets steady. So as you probably noticed, there is 3 stocks in my portfolio that is kinda having large weight right now, and we're gonna change that because we're gonna balance it out a lot. But we had to start somewhere just to get the dividends rolling, so I chose those because they have very good history and they have a long track record of keeping their dividend payments steady. And our 3 largest one, that is going to be Altria Group, which is a consumer stock. They do they're not very popular. Like, they're a shameful stock to own, but there's a very well run company. They have electronic cigarettes, tobacco products, this kind of stuff. They have been paying out dividends for more than 50 years straight, because so they're a dividend aristocrat. If you want to know more about dividend aristocrats, because that's a topic for a whole nother story, I'll link some more useful articles down below. Investopedia is your friend in this stuff, so go check it out if you're interested. And then we have Energy Product Partners. It's a pipeline company. They transport oil and gas for the big companies, and they are very good at it. Energy Product Partners has specialized their portfolio of pipelines in the very near hotspot zones in the US energy market. So they have sold off pretty much all of their non-related pipelines and small projects and stuff like that. Kept the large one, the profitable one, all of this nice stuff. And compared to a lot of other companies in the same sector, they are very conservative on their debt, which means that at current states, it doesn't look like the dividend is going to be in any risk. So the pipeline companies are known for having very large dividends. They're usually registered as K10 or LPs, which make them a little bit tricky with taxes sometimes. We're going to get into that later on, but for most companies, they are starting to turn more into C Corps for tax purposes, and that's gonna make them more attractive because that makes the whole thing of taxes way easier. Trust me on that one. But if we just jump straight into the third one, that is one of our largest one, and this is a different thing because this is a PIMCO Dynamic Credit ETF. And the difference between the PIMCO and the rest of our positions is that this is an ETF. It's not a company itself, it's managed by PIMCO. And the great thing about the PIMCO one is that it's a credit fund. So they look for opportunities all around the world to create the most accurate income for their owners, which is the shareholders of the ETF, and pay out this cash on a monthly basis. So this is the clue here. The PIMCO funds, they trade out on a monthly basis, which means you're gonna have money coming into your portfolio every single month. This is why I use this one as one of my pillars in this portfolio. Because every single month steady comes the money going in, and then I use this money to buy more stocks and increase my quarterly incomes instead. Because most companies, they pay on a quarterly dividends, but these PIMCO ones, they on a monthly one. You have a few companies doing it well. You have Income Realty and some other ones, but they are right at high price right now, as there's a lot of volatility and people are looking for safe stocks, and there's people like me looking for income stocks. So they're gonna be stiff priced for a while. So I would stay away from those for right now, but the PIMCO ones are a great opportunity right now. They have gone down quite a bit in the volatility of the market because people are selling off their stocks and all this kind of stuff, but their underlying credit and their value hasn't changed that much, so you could get a good deal for a decent price right now. I would definitely consider putting them into your dividend portfolio if you have the spare cash again. And remember, all these positions, everything, there is investments made, so they also include risks. You could lose the money. It's not really realistic, but I'm not a financial advisor. You guys are probably, hopefully doing your own research, and we're gonna get through this together. So let's just keep moving on. So there's one interesting thing that we're gonna look at in the chart again. Let's just jump back into it. But first off, if you see the difference between our largest positions and our largest contributors of dividends, you're gonna see that there's a lot of differences there. It's not always the largest companies giving the most. I mean, probably, but there's also a lot of the smaller positions that pay out a lot of dividends. And this is matching up because I take smaller positions in these companies because they are a lot more risky, but they also have a way higher dividend yield compared to their current valuations. Which means for a while, hopefully at least, I'm gonna get a couple of them, they will still pay out their dividends without cuts, and they will pay out a lot of dividends for a cheap buck, which means we get a lot of returns on these stocks, but there's also more volatility and the chances of the companies getting in trouble with their debt. And as we saw with Occidental a little while ago, when they get into debt, they just slash their dividends to save money. So we're not gonna keep the level of dividend yields at around 10% because there is a lot of risk in it. When I'm looking for new companies now, I'm looking at companies roughly at around between 3.5% and 5%. Not a lot over that, because a lot of over that, that's gonna be a lot of strain on their bottom lines, and it's gonna be a high risk for them being a little bit unstable in volatile markets, and the risk of cutting dividends is something that we're gonna try to avoid. We are building this dividend portfolio to try to get the most reliable income that we possibly can from the market. Which means if the companies are risky, they have a lot of debt, all this kind of stuff, there's also a chance that the dividends will go away. And then our whole point of investing in the company in the first place is gone. We're not looking for growth stocks here. We're not looking for the next Tesla or Facebook or Amazon right here. We're looking for the steady companies. I mean, we're looking for great companies, but we're also looking for safe companies. So some of the best companies we could invest in would be Coke, would be Caterpillar, Cisco, all these kind of steady, nice companies. They've been going for a long time, they're paying their dividends, and they're just continuing to do that. There's no way, or at least very slim way chances, that one of these stocks are gonna skyrocket tomorrow, up 50%, like Tesla, Amazon, all these kind of stocks could do. They're not growth machines anymore. They have a very good bottom line balance, they have a very good dividend policy, and they just keep making it paying out. And that's what we're after in this case. We are looking for those boring companies that they, no matter what, financial crisis, pandemics, all these kind of challenges to the market, they're gonna still have their money coming in. They're still gonna be paying their dividends to their owners. This making our portfolio a steady income flow. Because if we only took the risky ones, we could be getting a lot of money one month, and then something bad in the market happens, and they cut their dividends. Then we're losing our income stream here. And that's what we're trying to avoid. So I would rather settle for between 3.5% and 5% in a good company paying dividends than between 10 and 20% in a risky one. So that's what you're gonna see going forward, most of the changes in my portfolio. We're not gonna take a lot of more risky positions. We're gonna start looking for good discount deals on more steady and nice companies. History here is your friend. Saying that a company has been surviving for like 200 years, that's probably a company that could survive for a while longer, unless it's Kodak. But in this administration, even Kodak survives, so I mean, what's the point? And I'm gonna mention it once again. I did put the article down below, because I wrote an article about the next 5 stocks that I would like to add into my portfolio, and the reasons why I'm looking at just these stocks right now. So if you're interested in my opinion on this, do click the link down below to my Medium article, and go have a look. Alright, so I'm gonna throw some more charts at you for now, right now, because we're gonna look at some sectors. If you look at the current chart, I still don't know if we're gonna put it here, we're gonna put it here, maybe we're gonna put it on top of my face, so you don't have to look at me anymore. I don't know yet. You'll see it on the screen, right? Hope. I mean, if you don't see it on the screen, why are you watching my videos? Is anybody watching my videos? I hope somebody's watching my videos, because otherwise I'm just a almost bald guy sitting in a room alone, talking to a camera, putting it on the internet for nobody to see. Alright, let's get back to the charts for right now. So as you can see, my charts are very centered right now. We have some large exposure to a couple different sectors, mostly energy, consumer, financial, and real estate. I mean, not mostly, it's actually all of it. So for the total of all the 11 different sectors you have in the market, we are currently exposed to 4 of them. And as you could probably tell yourself, that's not very good diversification of our portfolio. And as I mentioned earlier, if you were listening, you did listen, right? Because otherwise we're gonna be back at the point of what is the point of me talking to the camera in a room alone, losing my hair, and then nobody's gonna listen. So let's try not avoid that. So remember again, smash the like button so I see that at least somebody's trying to listen to this video. But I'm getting derailed once again, so let's get back into the sectors. So you're gonna see that the 11 sectors of the investment world is the ones that we're gonna list. You know what? We're gonna put it right here so you can all see it. Nice. And we are currently exposed to 4 of them, which, as I've already said, is not very good. And this is something we're gonna work on. But the ones we have already chosen is very fundamental right here, because these are the ones that you can usually find a lot of dividends in. Consumer stocks, energy stock, finance stocks, and real estate stocks have a very good history of paying large dividends. IT stocks has started to come, but a lot of them is still in their growth phase, so they haven't really gotten into that. They are still, if you're looking at the market, they are still going up. They haven't really flat out yet, like most of these consumer stocks have. Like, there's no way Coke is gonna have a investment strat going like this for the next years. But stocks like Amazon, Tesla, and these kind of things, they still do. They're still growing, they're still expanding, all this stuff. They're not steady yet. So I'm gonna be holding off on IT for a little bit, but I'm definitely investing more in consumer stocks. And in financial stocks, I'm also gonna start looking a little bit more around, but that is also risky now because we have very low rent. And as long as the margins for the banks are low, the dividends will not be hiked either. So they're gonna probably keep it at current levels, but there's little chance for them being increased for the couple next years at least. So the sectors that I'm actually gonna start looking more into is industrials. Companies like Caterpillar is great. They've been paying out dividends for a long time, and there's no way people are gonna stop using their machines, because as the market is slowing down, economy is slowing down, the government is gonna start spending more money again, and what do then? They build houses, they build roads, they build whatever God knows, they build dams, they build, you get the point, right? So they're gonna be buying machinery, and who's gonna support that? Caterpillar is gonna do that, and healthcare stocks as well. You can have a lot of good healthcare stock. Mostly like big pharma and these kind of stock, they have a steady pipeline of projects. So they're, even though that they're going up and down, there's still gonna come new medicines because people need their medicine. And you have hospital stocks, which is gonna fall into, I'm gonna put them into the real estate part, because most of the hospital stocks you find are real estate investment trusts. So even though they are exposed to the healthcare sector, they're actually just properties pumping out money from private healthcare. But they're usually very good payouts, and they are also steady, because even things go up and down, there's not like people gonna stop needing hospitals or doctors or anything else. And doctors, sirens, all these people, they're gonna need an office. So the building is gonna stand there and the people's gonna be in it. But as for this video, the point is that I'm not gonna start recommending a lot of stocks in this video. I did recommend 5 yesterday. So if you do, click that damn link down below. You're gonna find 5 stocks that I'm gonna buy next when I get my next paycheck. Something to bear in mind there, because you're gonna need money to buy these stocks. No matter if they're discounted from last year or not, stocks are still very expensive. So you're gonna have to look at the big pictures, because even though they have fallen a lot for the last 12 months, they might still be at close to all-time highs. So do be careful, do look at the big charts here, not only for the last 12 months, before you start choosing your stocks to buy. Alright, so just wrap this all up a little bit. So we went through my portfolio, which looked something like this. We looked a lot at my exposure, which looked something like this. And we looked at some companies that I like. They look something like this. Now look, let's just jump back into the big first one, because as you see that my portfolio is not very large yet. I started this in early May, or at the end of April. God, I don't even remember, but around there somewhere. April, May, because the market was still going downhill, and I figured it was a good time to jump in. And we have currently threw in 2,234 US into the portfolio, and it's currently returning us, as we see in the chart down below, $243. This is annually. This is not per quarter, but this is for 12 months owning these shares. We're gonna get $243 left in dividends. We're gonna flip those back into the portfolio and keep it growing. But we're also gonna keep adding 100 per month, more if I have spare capital, but that's gonna come later on, because in the next video we're gonna start looking at how I'm building my other income sources, and I'm gonna redirect them into this portfolio here, making it grow faster and then hopefully expand it faster, and you get the deal. So I think that should be roughly it for today. I've been throwing a lot of charts at you guys. I've been rambling, I've derailed a couple times, but hopefully the essence made it through. If it did, please do let me know in the comments down below. So let's for now just wrap this up. I think there's a new video coming up next week, because you know I'm here to publish once on Tuesday and once on Friday every single week. But my articles on Medium comes every night, so if you're gonna like following me there as well to get some ideas on what I'm going on around in my head these days, please do click the links. There's no links up there anymore. Please do click the links down below in the description. You're gonna find my Medium profile, and you're also gonna find all the other good information down there. So do click the links, go check them out. Do remember to like and subscribe the video. Thank you guys for watching, and I'll see you again next time.